This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Bashardis. Thanks for joining us at XM.com. The yen absorbed some damage on Friday in the aftermath of the latest inflation report and some remarks by incoming Bank of Japan Governor Kazuo Ueda. Speaking before lawmakers, the next BoJ chief said inflation has started to peak, warning of softer inflation numbers next month as the government's energy subsidies to shield households finally kick in. The underlying message was that the central bank should not overreact to supply-driven inflation, even though he left the door open for policy normalization if the inflation trend improves. His cautious stance left some scars on the yen, which was already under pressure this month as investors recalibrated higher the interest rate trajectory in the US and Europe. Nonetheless, the bulls haven't thrown in the towel yet, as there's speculation the Bank of Japan might take the next step in its normalization campaign next month, now that wage growth is accelerating. The US dollar is about to close higher for a fourth straight week, as incoming data reinforced the notion that the Fed needs to stay tighter for longer to bring inflation under control. This repricing around Fed policy has propelled US yields much higher, boosting the dollar. One-year U.S. government bonds currently pay investors more than 5% to hold, offering investors a juicy risk-free return that acts like a gravitational force, attracting capital into the United States. On the other hand, rising yields and a stronger dollar are anathema for gold prices. Since gold does not pay any interest to hold and is typically priced in dollars, it becomes less and less attractive as bond yields edge higher and the dollar appreciates, making it more expensive for foreign investors to purchase the precious metal. In the stock market, there are two opposing forces right now: optimism that economic growth will be resilient versus concerns around interest rates and inflation reaccelerating. These conflicting dynamics have left investors in a tug-of-war, with some cheering the economy's strength, but others fearing it implies a longer period of high rates that could ultimately inflict more pain. The problem is that equity valuations are already discounting a strong economy. With the S&P 500 trading at 18 times earnings, the risk-reward for U.S. stocks seems unattractive, especially in an environment where earnings are contracting and yields are racing higher. This was today's Daily Market Comment. Thanks for joining us at XM.com.